But right now, it's time to welcome our first guest, Graham Summers. Graham Summers is President and Chief Marketing Strategist of Phoenix Capital Research, a global investment strategy firm right in Washington, D.C. His cutting-edge business and research insights have been featured in media outlets around the world, including NBC, CNN Money, Fox Business, and Rolling Stone magazine. He's also the author of best-selling book, The Everything Bubble, the endgame for central bank policy. So Graham, tell us, what prompted you to write The Everything Bubble?
Oh, sure. So the concern I had was that in the aftermath of the 2008 crisis, central banks took extraordinary monetary measures to try and sort of sustain the system. Now, in the actual depth of the crisis, I thought that was obviously just fine. You're trying to support what looked to be a really deflationary collapse. But the concern I had was that once you got past about 2011, 2012, what should have been considered emergency monetary measures actually became normalized. So what you saw was central banks maintaining policies that usually you'd only use during a crisis and just sustaining them well into what you would be considered a recovery. And in particular, once you started shifting into seeing central banks implementing negative interest rate policy or even open-end quantitative programs or quantitative easing programs, meaning programs where they're buying assets from banks and it's just open-ended, there's no deadline in mind, I became increasingly concerned that what was really happening was that central banks were attempting to corner the sovereign bond market and in that way kind of create a false risk profile for the financial system. And it's my view that that's essentially what they did, and it continued onward. We still have NERP and QE and multiple central banks going right now. And so that became the concern because, as you well know, the sovereign bond market is the effective backbone of the financial system. No currency is currently backed by gold or by any finite assets. So it's actually sovereign bonds are considered the senior most asset in the financial system.
But what do you think caused it though? How did we get here? I mean, is it because they tried to push people up the risk curve, as many have said, to create more of an asset bubble so people feel wealthy and maybe they go out and spend more money? I mean, what's the motivation?
I think it's a number of things, honestly, and that's sort of the trillion-dollar question. I mean, on the one hand, you've got hubris and you've also got some career risk, which is, ever since Volcker, nobody at the Fed has ever really wanted to engage in an aggressive tightening campaign because it usually results in that person being canned. So that's one component. The other issue is that there's a chart in the book, but if you look at the total debt securities in the United States financial system and you compare that to the GDP, it really went parabolic starting in the 90s. And the concern, I think, is that really their view is that debt deflation is actually a systemic risk. And so they don't want to take any chances with that spreading into sovereign bonds. Whether it would or would not is very difficult to gauge because since effectively the late 90s, anytime the Federal Reserve has faced any kind of crisis of any sorts, their goal is to just be as loose as possible with monetary policy.
Right.
And so the end result is I think they've been slowly moving up the financial asset food chain, first with tech stocks, then with housing, and now with sovereign bonds. And to answer your question, I think it's just a combination career risk, hubris. I think it's really hoping that there'd be some kind of wealth effect. And then, of course, there's the TINA trade. There is no alternative, which is if bonds and income producing assets are at very low yields, hopefully you're going to force people into riskier assets like stocks and things.
That's pushing the classic pushing people up the risk curve argument, 100%. Yeah. We need to leave it there for this segment. But we'll be back. We'll be back with a lot more in terms of words of wisdom from our new friend, Graham Summers. You stay with us. We'll be back in a moment right here on The Income Generation. Now it's time to welcome back Graham Summers. I've got a theory, and you could tell me whether or not you think that there's anything to this or not, but I feel as though we've been artificially stimulating the economy now for about 30 years. Car leases came out 30 years ago where people all of a sudden got this belief, well, heck, if I'm going to have a car payment forever, I might as well get a new car every 2-3 years. Right. The first liar loans came out in the late 80s, mortgages, where if you put 30% down, you could say you made more money than Donald Trump, and nobody cared. So it seems like this is much of really a longer cycle. And now it's just that the central banks are getting involved. Am I on to anything?
Yeah, I think you're correct. I think the real issue here is that once you abandoned the gold standard in the 70s, and just to clarify, I'm not a gold bug. The view I have is simply if your currency isn't tagged to anything, there's really no limit to what the central bank can get involved in. If you combine that with the introduction of credit cards and mortgages and junior debt securities, what you've really got is about a 40-year credit bubble that's been generated. And that's really, I refer to it as a debt bubble. But when I say debt bubble, it's not necessarily just sovereign bonds. It's really just this idea that debt's the answer to any issue facing the economy. And really what it is that since I believe the early 70s, the Fed has been effectively papering over a decline in living standards in the US. And the way they're doing this is just by using credit. You know, if your incomes are not actually keeping up with cost of living, you use a credit card. You start using mortgages. You start using things that 80 years ago no one would have ever imagined was possible.
Yep.
And I think you hit the nail on the head. I think the real issue, though, and the reason central banks are increasingly being involved, is that because the system has so much debt in it at this point, when you combine all these different debt securities, that any whiff of debt deflation becomes a systemic issue.
Right.
And if you actually if you look at the debt deflation we have,
Graham, we need to take I'm sorry to interrupt. We need to take a commercial break again in just a moment. When you come back, we're going to ask you a little bit about what the government can do to fix this problem, what we can do. All right, we'll be right back here on The Income Generation. I'm David Scranton. Now it's time once again to welcome back Graham Summers. And Graham, I've got two questions for you that our viewers need burning answers to. Okay. One is, your book came out a year ago. What's happened, if anything, in the last year to make the trajectory any better or any worse?
That's an excellent question. Really, the issue we're dealing with is, can they normalize the situation we're in? And we're seeing that the central banks are trying to do that. You've got the Federal Reserve now engaging in quantitative tightening. You've got them hiking rates. The European central banks announced they'll be ending their own QE program.
Which it sounds like you're in favor of, correct?
It's hard to tell. I mean, really the big question is, can they normalize what they've done? Sure. Because this has never happened in history before. You've never had actual nominal negative rates in some places. You've never had a global coordinated campaign by every central bank in the world to try and corner their sovereign bonds. So the question is, can they normalize it or not? So far, it looks like the Federal Reserve has been successful at doing this. They've managed to drain about $250 billion off their balance sheet. They've managed to hike rates up to 2%. But really the question is going to be, how far can they go before something breaks? And that's the question no one really knows. You know, we're in really unprecedented waters at this point. The good news is for income investors is that if you're looking to be involved in the bond market, if something starts to break, bonds are the things that they're going to be defending the most. So you're probably going to be seeing a lot of central banking policy if we enter another crisis that would be supportive of bond prices.
So can we fix it, though? In the 45 seconds or so we have left, you know, we're trying to raise rates, but a lot of the rest of the world is still easing. So
yeah, and
I think part of that's,
I think a little bit of that's intentional. I think that's the Fed's trying to be supportive of the dollar by making capital flow to the United States. You see that in the stock market too. The U.S. is one of the few markets that's actually held up. Most emerging markets and even the developed markets in Europe are down significantly this year. Really, the question is going to be, can they get to a state where the economic growth is significant enough that the U.S. isn't running such massive deficits and the debt starts getting paid off? That's very difficult to say. We're running very large deficits now, and that's during GDP growth of 3-4%. So very hard to say. It's very clear the Trump administration is just trying to do a sort of growth approach to this. But really, at the end of the day, the question is going to be, at what point do the bond markets revolt? And it's very hard to tell. I mean, we're dealing with such a senior asset class that trying to time that's going to be very difficult.
But it sounds like you're not concerned about a bond bubble per se, more of a debt bubble as I am. So real quick, where can everybody get your book, The Everything Bubble?
Well, it's currently on Amazon. You can get it both in a paperback and actually Kindle's running a very significant sale right now on it. And just type in The Everything Bubble to Amazon and it'll pop up. And I'd be delighted if you picked up a copy and left us a review.
Graham Summers, thank you very much. We'll be right back.
My pleasure. Thank you, Dave.